Welcome to Empire Life's TRIIPSS webinar, Why Segregated Funds. My name is Peter Wouters. Before we get started, I thought it would be important, in fact, our compliance department thinks it's very important that I show you the most important slide of this entire presentation, and that's the disclaimer at the very beginning. This presentation, of course, does reflect the views of Empire Life as of the date presented, and as happens from time to time, and let's think about this COVID pandemic that we're actually going through, the news can change hourly. The information, of course, is presented for general information purposes and is not to be construed as providing legal, tax, financial, or professional advice. Long-term contractual guarantees on investments exist, and we should all know what segregated funds are. What may be missed is why incorporate these types of insurance-based investments into the suite of solutions you offer your clients when structuring their investment portfolios. That's the purpose of today's session. We will invest some time in sharing some consumer insights and strong preferences, product benefits, and advantages which support the premise that having some guarantees in a portfolio makes sense. This session can show why guaranteed investment funds help your business while helping your clients first. What's more, advisors will walk away with considerations that can attract new business, generate revenue, and help maintain assets under administration generation to generation. And do this all while focusing on helping clients sleep at night by addressing their concerns first and foremost. Some of today's content will emphasize the advantages of segregated funds under current volatile market conditions in the COVID-19 pandemic. These times give us the opportunity, along with our clients, to reflect, refocus, learn, develop, and engage in discussions that can provide safeguards and continuity in a largely disrupted world. We hope you appreciate this safe, health risk-free alternative to improving your professional development and acquiring continuing education credits. Canadians want investment guarantees. Almost 9 in 10 Canadians, 87% to be exact, of those Canadians that are over the age of 55, want investments with guarantees on the principal and want growth opportunities on those investments. The financial literacy gap is that 6 out of 10 don't know this option exists with guaranteed investment funds available from insurance companies. And both these statistics come from an Ipsos poll that was conducted in November 2016, entitled, Could Guaranteed Investment Funds Help Your Business and Corporate Clients? Now think of the concern that small business owners may have with protecting their assets in the event of problems or issues with their business. Why segregated funds? They offer guarantees that can protect the value of the personal assets of a corporation's owner at maturity or death. In fact, for people letting their money grow for the long term, the death benefit guarantees only go in one direction, up. Guarantees, of course, are reduced proportionally for withdrawals, and gains can be periodically locked in during the investor's lifetime. We offer all of that, and you can too. If your focus is on investors aged 55 and over and business owners, improving the financial literacy level of these clients and incorporating product solutions that offer guarantees into your recommendations can be a win-win for clients and advisors. There are challenges you will face, as evidenced by the examples on the following pages. There are answers you can provide to address them. Here is an excerpt from one investment website. High returns that you can trust. Guaranteed healthy returns for your hard-earned cash. And without going through the entire piece, the promotion is that you can invest your money for 12 months at 15% in US dollars, or invest your money for 6 months and get 12% on your money. Pretty lofty guarantees. A number of investors continually chase returns and offers like this and figure they can do this repeatedly and beat the market. Now consider the real return that the investment must return in light of the claim by the fund manager running this investment. We do not charge you any fees of any kind. No management fees, no allocation fees, nor any other. We earn our profit from real performance. Across our diversified portfolio, we consistently get net returns that are higher than those due to our customers. We take our part for a job well done and pass on the rest to our valued clients. We take risk off your hands and make every dollar we get from good performance. What do the fund managers have to earn to make some money on this deal? The target needs to be higher than what the investors have been promised, so more than 12 or even 15%. Unless, of course, the fund manager is willing to sacrifice some or all compensation, and that's hardly likely. The question to ask is this: how sustainable can offers like this be in today's environment, and even when looking in the rearview mirror on past offers of rates of return? There has been a downward trend on legitimate guaranteed rates of return for decades, particularly long-term guarantees. So are guarantees guaranteed? Let's look at these headlines. The dark side of 20% annual returns. A guaranteed return of over 17%. Mark Cuban explains how to make a 16% guaranteed return. And that other one, First Tower, who could support some of these returns because they're a subprime lender that loans funds to borrowers needing small, short-term installment loans at interest rates approaching 65%. There's risk involved here and a massive spread between what the investor is being offered and what is being charged. Not only do investors who feel they have inadequate savings chase returns, they do it in a world where volatility and unpredictability are the new norms. The 2019 Market Perception Survey by Allianz reconfirmed the findings that most people, and by that I mean 7 out of 10, say that it is important to have some retirement savings in a financial product that protects from loss. It goes on to share that the same proportion of people with higher investable assets, $200,000 or more, would give up potential gains for a financial product that protects a portion of their retirement. But are guarantees guaranteed? Looking at the headlines on this slide, ask yourselves, if it is so easy to get guarantees that high, then why don't insurance companies and banks offer them too? Today, like in years past, more and more people are concerned about the return of their money, not just the return on their money. Which brings us to steady yields over time. Steady yields don't seem to be as steady as they imply, particularly if investors need the money when the dips occur. And there are a lot of dips, as you can see in this chart. Guarantees typically aren't long-term, and most are not contractual. Probabilities are not guarantees. Listening to the position that the probability a certain investment will not fail to make money over the long term, whether that's 10 years, 20 years, or even 30 years, should keep in mind the caveats that go with that. And the caveats include the following. There's a very high probability that a particular investment will outperform inflation, achieve a certain rate of return, or has never lost money over a 10, 20, or 30-year period. Provided, of course, the markets perform well and GDP grows and consumer behavior is kept in check. Yeah, and. Probabilities are not contractual guarantees, and guarantees to mitigate risk have a place in our lives as consumers and advisors. Empire's guaranteed investment funds replace hope with guarantees. They add a contractual guaranteed safety net to investments and cash flow. Also keep in mind that average rates of return may work in the accumulation phase of investing. They operate quite differently when you're in the decumulation or spending phases of investing, or when someone passes away and the markets are down, or they need the money at a point in time. No ands, ifs, or buts. Sequence of returns are a key consideration when drawing income and cash from investments. But most investments pay scant attention to seemingly short-term aberrations and their long-term effect on when money runs out. Let's look at rising markets and locking in gains. Resets are a valuable segregated fund feature, which in effect locks in gains for the purpose of the benefit guarantee when the value of the segregated fund investments is higher than the benefit guarantees. This feature in action boosts the value of the guarantee in rising markets and subsequent drops in the markets that may follow, such as what we're experiencing in 2020 with the COVID-19 pandemic. So again, the segregated fund advantage is that they can lock in gains for the purposes of benefit guarantee using resets. They can lock in those gains without triggering capital gains. There's no transaction charges. You stay invested and you don't miss out because there are autopilot options that exist for the client and the advisor. Let's consider guarantees in a market scenario and see how they work. Here's a death benefit example. The death benefit will always be the greater of the market value or the guaranteed percentage of the deposits. In this example, Patrick invests $1 million in segregated funds with a 100% death benefit guarantee. Patrick names his wife as his beneficiary. If Patrick were to die while the funds were worth $1.22 million, then his wife would receive the higher value of $1.22 million. In this instance, the market value is the greater of the two values. Now, why would this be of interest to clients and advisors? Well, if the market value drops shortly after death or before the estate gets settled, then that higher value is secured for Patrick's wife, which is not so with your typical investment. But this example doesn't show the death benefit guarantee at work. Let's look at an example where the market is down and where some of the real benefits kick in. Here again, Patrick invests $1 million in a segregated fund. If he were to die while his funds had decreased to $700,000 due to down markets, his wife would receive $1 million. This is the real value of the death benefit guarantee at work when beneficiaries need it most. Remember, if Patrick had invested in mutual funds, the check would have only been for $700,000. What may have been considered an extreme example here in 2019 is now a very real threat in 2020. Now think of the current market reactions to the COVID-19 pandemic. A death may always be considered untimely. Our segregated funds offer the type of downside protection that is so valuable during times like these. Investors looking for safe havens. They are just as concerned, perhaps even more concerned, again about the return of their money as they are about the return on their money. When the markets dropped dramatically in 2008, Empire Life paid out millions and millions of dollars in top-up guarantees for death and maturity. We are ready to do this again. We are one of the most strongly capitalized insurers in Canada when it comes to dealing with an environment like the one we're in due to COVID-19. Let's move on. Let's consider creditor protection and segregated funds and estate planning. For non-registered investments, there are a number of advantages that actually exist. Probate avoidance, the opportunity that you may avoid estate settlement fees, that you can transfer assets without delays, and distribute assets with privacy, as well as achieve customized distribution. The proceeds of the segregated fund policy will be paid directly to the named beneficiary, bypassing the probate process and fees. Probate is a public process that can be both costly and lengthy. Probate fees may not be a significant factor, but they bother most clients. What's more, estate settlement fees can be much higher. Think about executors' fees, both for gathering assets plus distributing them, valuation costs, and legal expenses. By properly structuring segregated funds, beneficiaries receive more of the proceeds quickly, and your client's financial affairs are kept private. The savings could be in the thousands to tens of thousands of dollars. Benefits going to family, friends, and favorite causes. That makes advisors look good too, since it demonstrates they are looking beyond the grave. And then let's consider this ability to transfer assets without delays. There is that saying that time is money. Think about this. Would your clients and their beneficiaries prefer to have your clients' investments passed on to family and favorite causes in 14 to 21 days instead of 14 to 21 months? The proceeds of segregated funds with a named beneficiary designation can generally be transferred on death effectively and efficiently in a matter of weeks. The average estate in Canada takes 1.5 to 2 years or more to settle. It may even be longer. During that time, the executor or estate administrator needs to gather all estate assets, which may mean liquidation of a portfolio and the transfer out of those invested assets under the advisor's management. The connection between that money and the ultimate owner may easily be broken, if only because of the impact of time delays. Privacy is a highly valued asset and feature and factor that's really felt to be important by advisors and by clients as well. Assets like a segregated fund with a named beneficiary may bypass outside the estate, away from the eyes of beneficiaries under a will and the public, given the alternative. Customized distribution is also possible. Advisors can provide clients with an inexpensive and efficient option for customizing just how beneficiaries will receive proceeds of a segregated fund. Equal doesn't necessarily mean receiving their share the same way. If there is a named beneficiary on an insurance-based investment, your client's segregated funds may be protected from seizure by creditors. This is an important benefit to professionals, small business owners, or anyone who could be involved in a lawsuit or bankruptcy and are concerned about protecting personal assets, a feature of insurance-based investments only. This concern may be heightened when businesses is interrupted or restricted due to the pandemic, and even after things settle down, if a client's business or job has suffered for an extended period and obligations cannot be met. For clients purchasing segregated funds, and if protection from creditors is a significant reason for purchasing a policy, independent legal advice should be obtained. Where the beneficiary is a member of the preferred or family class, and by that I mean spouse, child, grandchild, or parent of the life insured in the common law provinces, or an irrevocable beneficiary is in place, no matter where that is, or funds are locked in and protected under provincial legislation, the trustee in bankruptcy cannot force the surrender of a life insurance or annuity contract to satisfy the claims of the bankrupt's creditors while the owner is alive. An insurance-based investment may be protected from creditors of the estate so long as anyone other than the estate is named as beneficiary. What do clients have to do to replicate this using other structures? How much would it cost, and is it time and court tested to actually work? Properly set up with the insurance company, this is a simple, inexpensive, and valuable advantage for anyone that runs the risk of having to deal with creditors, taking some of the worry and risk out of being in business for yourself. Financial advisors need not rely on what other professional advisors are doing or fail to do to cover this off. The conversation with clients can go well beyond the current transaction to other holistic planning considerations, something again that is valued by clients, particularly older clients. Let's go through an example. Frank is a business owner who's run into some serious issues at work. His business had gone bankrupt, triggering a stroke. He died about a month later. His estate still owed the bank a large amount of money. And in going through his papers, his wife found out that Frank had a securities portfolio as well as a segregated fund in which he had named his wife the beneficiary some years back while the business was successful. True or false? The bank can seize everything, including the house, his securities portfolio, and the proceeds of the segregated fund policy. Well, the answer to that is false. The bank may not seize the value of the segregated fund because Frank's wife was named beneficiary. And again, as a reminder, a beneficiary can be a spouse or common law partner, parent, child, or grandchild of the annuitant, except, of course, in Quebec, where the beneficiary is the spouse, parent, child, or grandchild of the contract owner, or, of course, across the country if the beneficiary is irrevocable. If the creditor's claim had not been triggered until after Frank's death, and he had named anyone as a beneficiary of his segregated fund, the proceeds would have been offered protection from the bank as a creditor. Remember, those assets pass outside the estate. And note that there are certain circumstances where protection from creditors will not exist. If, again, the possible protection from creditors is an important consideration, speak with a legal advisor. And of course, please note there are certain conditions where creditor protection is not absolute, and Empire Life recommends that you do seek independent legal advice. So good news, and something that could happen this year. or even next year, depending on how long we've got to deal with this pandemic. Let's put it all together. Let's see those insurance features at work in this example. Jane invested $500,000 in segregated funds, choosing the 100% death benefit guarantee because she is concerned about her family. She names her husband, John, as her beneficiary. Jane passes away. This is the same time as a market pullback, when the value of her investments has decreased to $430,000. Because Jane had the foresight to invest in segregated funds, her family is not impacted by market volatility. The insurance company will top up the death benefit by $70,000, restoring her original investment. I should point out that in a non-registered account, the top up is a taxable gain. It may be offset by the actual capital loss. There may still be some taxes owed by your estate if the account were non-registered, generating some earned interest and dividends. Because Jane is designated as beneficiary, before John is designated as beneficiary, the death proceeds may bypass probate, significantly reducing the time required to pay the death proceeds to John, as well as eliminating money owed to the government. John will receive a check for the full $500,000, in keeping with Jane's original plans. And that also removes some of the investment risk for clients and advisors. Death may determine the market value of an investment. And that's great if the markets are going up at the time, but nobody can guarantee that this will be the environment or that the money will be paid out in a timely manner before the markets drop after death. So why should death be the dictator of the estate value of an investment transferred to a beneficiary in a down market? The benefit to you and your clients is that the guesswork and probabilities with all their caveats are gone when you use a segregated fund. Our segregated funds offer a valuable safety net in times like these. They can be used as a tool to weave estate planning into wealth management. And now that you know how resets work, you'll be pleased to know that our automatic death benefit guarantee resets does the work for you. It's done on an automatic basis. The death benefit guarantee resets automatically every year on the policy date, with the final reset taking place on the annuitant's 80th birthday. The reset helps to lock in any market growth and can help address inflation and market risks. The reset keeps the death benefit guarantee amount relevant. As you can see from the chart, depending on the annuitant's birthday, the contract may have two death benefit guarantees resets in the same year. Busy advisors appreciate this automatic feature for its administrative ease, fail-safe benefits, and guarantee. One of the most popular topics, or perhaps an unpopular discussion to be having, is the issue of fees in segregated funds and how that may compare to fees in other investments. Let me start off by saying that fees may be higher, but they aren't necessarily so, and costs may be lower if you're looking at insurance-based investments. When you look at insurance-based investments, you need to understand and explain fees and costs, and that fees aren't necessarily higher. With most investments, the responsibility to track and report capital gains and losses falls to the investor. Certain transactions that contribute to an increase in the adjusted cost base, or ACB, may be missed. So non-registered investors, including small businesses, can end up paying additional capital gains taxes unnecessarily or get audited. With segregated funds, the insurance company keeps track of each unit holder's adjusted cost base. When units are redeemed, Empire Life will calculate the realized gain or loss and report this on the investor's T3 tax form. There is no need to spend time tracking adjusted cost base or paying an accountant to do it. The alternative to segregated funds presents complexity and higher fees. Think about the underlying costs of tracking and reporting for dollar cost averaging or tranching strategies. And unlike mutual funds, guaranteed investment funds can flow net capital losses through to the investor. The investor can apply these losses against other capital gains in the same year, or carry back those losses up to 3 years. This unique feature creates additional tax planning opportunities. Work that advantage into the idea of investing in a greater proportion of equity-based funds due to consumer confidence in the underlying guarantees. These investments are also protected under Assurance, and Empire Life is a member of Assurance, which is the not-for-profit organization that protects Canadian policyholders in the event their insurance company fails. And details about Assurance protection are available at www.assurance.ca or by calling the Assurance Information Center. And all of this is an important benefit when there are concerns about the stability or viability of a company holding your investments, particularly in a time like this. People will just worry and wonder. What these investments can do in terms of the guarantees they offer is lock in gains on investment funds, and they make for simpler reporting for income taxes, saving you time, headaches, and costs. Properly set up, the proceeds of insurance-based investments may bypass probate on death and offer privacy. They are paid directly to named beneficiaries. Distributions may be customized, lump sum, periodic payments, or combinations of the two to deal with unique concerns. There is even the potential for creditor protection, particularly important, as I said, for business owners. These features, all of them, speak to considerations on risk, volatility, peace of mind, simplicity, privacy, predictability, and quality. These built-in costs offset and may be far less than the extra costs involved in tax preparation, valuation, drawing up legal documents, and dealing with an estate and its distribution to replicate the benefits offered through insurance-based investments. That's why these investments may be very attractive and beneficial to investors. That's the ammunition you should be using in your discussions about fees versus costs. Here's an example. Let's consider a segregated fund contract to another investment, a mutual fund, stocks, or bonds. The investment value in both situations is $1 million. With a segregated fund with 100% guarantee, death benefit guarantee, the beneficiary or the estate would get the greater of the death benefit guarantee and the current market value. With another investment, it would be the current market value, which could be $1 million, $700,000, $500,000, or a higher amount than the original million, which would also be true with the segregated fund. The estate administration tax, and again, this is based on Ontario, would be zero with a named beneficiary, $14,250 with other investments. Legal fees at 3.5% would knock up those settlement costs by another $30,000. Executors' fees of 3 to 5%. And at the low end, at 3%, would knock it up another $30,000. And again, even if you said, well, my brother, my sister, my wife, my daughter could do that themselves, they may still need help on accounting fees, and those aren't going to be inexpensive. If there are DSC fees, deferred sales charges fees, it'd be zero for the segregated fund contract. If those exist in other investments, there could be in a range from 0 to 5%. We'll start in the middle, could be another $30,000. The stark difference in estimated costs upon death is zero on a segregated fund contract and $104,250 with other investments. With a difference then, significant difference then of monies that are going to go to elsewhere. They're not going to get paid quickly and directly to beneficiaries, ensuring the details are kept private if they're sitting in another investment. Because with other investments, they're paid to beneficiaries once the will has been probated, once all expenses have been paid, which can be a lengthy process and, of course, is publicly available. Now, this is a marketing piece that you can use. When you can name a beneficiary of a non-registered investment and the proceeds pass outside the estate, what are you potentially protecting your estate from? There's often a difference between the gross value of the estate and the distributable amount. Recognize that the actual amount of money your family or charity receives after your passing depends on the fees, taxes, and handling charges for its transfer. Here's what might chip away at your investment without the type of protection a segregated fund may offer. Losses in value due to market drops, deferred sales charges, estate taxes or probate, executors' fees, legal and accounting fees, and missed opportunities by not having access to those funds earlier. And this is over and above delays in settlement, inevitable with social distancing directives and the ceasing of face-to-face meetings during the current pandemic. Here's one more point to keep in mind: preferred pricing benefits. You can build more wealth by consolidating your assets at Empire Life. All of your individual guaranteed investment fund policies are automatically linked. Householding of family members' policies and corporately owned policies are available upon request. Management fee credits are automatically used to buy additional fund units. And you and your clients are used to doing this with other investment options. We offer them too, providing consistency and options for ease of understanding and buy in. Now, after all I've said so far, you may be thinking insurance based investments and specifically segregated funds. Yeah, so what? You're an insurance company. Naturally, you favor them. But what else is in it for advisors? Well, these survey results about financial advice and insurance based products should pique your interest in learning more and incorporating these products in active, ongoing discussions with clients. Of those households who do not own segregated funds, less than 21% would highly recommend their advisor to someone else. That jumps to almost 30% for those households who do own segregated funds. For those same households who do own segregated funds, the percentage that would consider switching advisors is about 10.6%, jumping to almost 16% of those households who do not own segregated funds. I call this the 50% factor. That's the advantage for you for incorporating segregated funds even more actively into the portfolio, into the recommendations you make, more referrals, and more stickiness of assets and clients. Recent surveys covered in Serving Complex Client Needs and Julie Littlechild's Absolute Engagement, shared on March 25th, 2020, have found a dramatic increase in the desire of investors to want to reach out to advisors. They need help, comfort, and guidance. Clients are looking for leadership from advisors who could demonstrate that they are responsible, responsive, and reliable. Why segregated funds? The use of segregated funds can demonstrate those traits. And by the way, we sell mutual funds too, offering the same value and quality asset selection, portfolio construction, and performance if guarantees simply aren't as important to you as they may be to a lot of your clients. Let's spend a few minutes talking about guaranteed withdrawal benefit plans and Empire Life's Class Plus 3.0. Class Plus 3.0 is a segregated fund contract similar to what we've been learning about. It offers a death benefit guarantee, a maturity benefit guarantee, a death benefit guarantee reset, estate planning advantages, and the potential for creditor protection. The distinguishing difference and benefit is that it includes a guaranteed withdrawal benefit. Let's take a closer look. The interest in guaranteed lifetime income and its importance to aging Canadians is growing rapidly. According to the 2017 report, Designing Retirement Schemes That Canadians Want, 9 in 10 aging Canadians want guaranteed income for life. 80% of Canadians see it as a highly valuable supplement to government benefits. See, many Canadians are not eligible for maximum benefits under the Canada Pension Plan or Quebec Pension Plan or Old Age Security, or may see those benefits drop when a spouse passes away. Fewer have defined benefit pension plans through work. And that means a quickly increasing number of aging Canadians do not have an adequate base of guaranteed lifetime income in retirement provided by others. There's never increasing onus on individuals to ensure they structure their long-term assets in such a way that they have sustainable, secure income through the various stages of retirement, and that the income flow is guaranteed, freeing up their worries, the worries of their parents, their partners, their children, and those who may need to step in and manage their financial affairs due to incapacity. You can get guaranteed retirement income for life with Class Plus 3.0, assuming no excess withdrawals. So let me introduce you to the 90% factors, what most Canadians want. 97% desire a predictable income. 90% of Canadians are willing to contribute more to ensure it. 98% desire a lifetime income, and 91% are willing to pay more to guarantee a secure lifetime retirement income. This speaks again to the matter of fees and costs I discussed earlier, particularly facts 2 and 4 on this screen. In designing retirement plans that Canadians want, an overwhelming majority say they are willing to pay more to get both predictable income and to guarantee that it will be a secure income for life. Now add these considerations. As we age, there's less room for error. Think about cognitive abilities, sensory impairment, both sight and hearing, access to pertinent knowledge, if only physical, including social isolation, like what we're going through right now. The increased ratio of fixed versus variable expenses due to lifestyle freedom and the ability to move about. What about the time to recover from losses in assets and the value of those assets? Think about the markets in 2020. Losses in income stream, the death of a partner, payments that cease after a number of years, extraordinary expenses that reduce investable assets that are generating income streams, or returns that are lower than planned in the early years of withdrawal, or perhaps are negative returns in those early years of withdrawal, referred to, of course, as sequence of returns risk, or a combination of any of these things. All are very relevant in the current volatile market driven by pandemic fears. Segregated funds address all of these and arguably simpler and cheaper than other alternatives for your clients, their families, and you as advisors. Class Plus 3.0 is one of the few true guaranteed withdrawal benefit products in the marketplace. Guaranteed retirement income for life is what Canadians want, and with Class Plus 3.0, you are guaranteed income for life as long as there are no excess withdrawals. The 4% income-based bonus rate is guaranteed, not variable, unlike some products out there. It is added to the income base at the end of each calendar year for the first 20 years of the contract if no withdrawals are made for that year. Annual automatic income resets means that your client's income may be bumped up. Retirement income privileges let your clients stop and resume their income without penalty. This facilitates tax planning during the income phases of your clients' lives for non-registered assets. The 75% death benefit and maturity benefit guarantees provide your client with a baseline of financial support. We offer an automatic death benefit guarantee reset every 3 years, which locks in any market gains. There's a range of investment options, including emblem guaranteed investment fund portfolios, offering variety and some customization of investment choices. You've now heard a lot of reasons to consider segregated funds for part of your client's portfolio. A financial opinion article in a national newspaper focused on the maturity benefit, stating not to buy a product that protects you from losing money in the stock market after markets have crashed, like it has during this COVID-19 crisis. 3 glaring points were missed. 1, the death benefit guarantee protects deposits and hence beneficiaries and estate values during a roller coaster ride where markets fall, then rise again, only to fall again, and later on the annuitant passes away. The reset feature locks in higher values on policy anniversary dates, which vary by contract. 2, the benefit is available regardless of the health of the annuitant or the policyholder. And 3, the writer states that the best time to buy a segregated fund might have been before the markets crashed, not after, though that advice wasn't shared back then. Informed investors and advisors recognize that this is akin to timing the market. It's time in the market that counts. A maturity guarantee, available on the maturity date of the contract, is not the same as a death benefit guarantee that is available anytime during the contract period. And it's a guarantee that may be higher if market values are higher than initial deposits on reset dates. These and all the other points I bring up during this session answer the question, why incorporate segregated funds into your discussions and recommendations when structuring your clients' portfolios? So why Class Plus 3.0? Let's consider the benefit in a down market, like the one we're going through right now. Meet John, age 51, who's looking to retire at age 65. In the following 2 examples, regardless of whether markets go up or down, our guaranteed withdrawal benefit plan, Class Plus 3.0, can meet John's income gap. By combining his guaranteed withdrawal benefit income via Class Plus 3.0 and his government benefits, John may generate enough to cover his fixed expenses. Let's consider how our guaranteed withdrawal benefit program works in a down market, much like the one during the pandemic. The 4% annual income-based bonus, credited in the first 20 years of the contract, assuming of course no withdrawals have been made, contributes to John's future income and protects him from market risk and inflation. Can your alternative contractually guarantee this will happen each of these years and in a world of lower projected returns? John's income base would grow from his initial investment of $250,000 to $390,000 by age 65, and his income would be based on that higher number of $390,000. Not so with an alternate investment. John will receive guaranteed income for life of $15,600. And that money comes from the fact that we're at age 65, for example, and that percentage payout can change. $390,000 at age 65 times 4%, which would be the lifetime withdrawal amount, kicks out mathematically $15,600. Now think about that. The federal government has reduced minimum withdrawals from RIFs, rich retirement income funds, and payments coming out of defined contribution pension plans by 25% to give retirees time to recover from market losses and help with sequence of returns risk. Our guaranteed withdrawal benefit plan offers additional relief from sequence of return risk when mandatory withdrawals are made during a period when the investment is experiencing negative returns, like during the pandemic. The lifetime withdrawal amount will continue to increase each year that John waits to receive income. John elected to receive income at age 65, so his lifetime withdrawal amount is 4%. Remember, the vast majority of Canadians highly value guaranteed lifetime income. This product takes some of the risk away from timing the market when income is needed, easing the stress of clients and advisors alike. It protects your value proposition, particularly in retirement income planning, putting part of the overall solution on autopilot. Empire's Class Plus 3.0 replaces hope with guarantees. It again adds a safety net to investments and cash flow. How does Class Plus 3.0 work in upmarket? The 4% annual income-based bonus contributes to John's potential future income, the same as the example I just went through. John benefits from the annual automatic income reset as his income may be recalculated upwards. The income base, which is reset every 3 years, locks in any market gains. The income-based bonus and the income-based reset combine to help grow John's income base from $250,000 to over $500,000, $537,000 by age 65. When John is ready to retire, assuming no withdrawals are made up until that point in time, his minimum guaranteed lifetime income will be $21,500. Again, using that number, $537,000 in that notional account times 4%, which at age 65 is the lifetime withdrawal amount factor at age 65. If John's has this money in a rich retirement income fund and the minimum is higher than his income in any year, John can withdraw the higher amount without penalty. This feature simply is not available on a contractually guaranteed basis from other investments. This product solution builds the income base clients are looking for to cover fixed expenses and fills in the gap left by not optimizing government benefits or defined benefit pension plan. That in turn may provide more latitude for investing with other assets, flexibility that benefits clients and advisors alike. Let's finally consider an Empire Life GIC, Guaranteed Interest Certificates, lifetime advantages. Like the one that Empire Life offers for non-registered monies in this example, in terms of the advantages during the owner's lifetime and a beneficiary has been named. With a bank GIC, of course, there is no direct beneficiary opportunity. Payouts are always done on a lump sum basis, and that whole process may be public via probate if that's how it goes through. No protection from creditors, and it's not pension credit eligible. With insurance GIC, you can name a beneficiary, and as a result of that, you can also structure your payouts, lump sums, periodic payments, or a combination thereof. And let it be private because it passes outside the estate. There may be protection from creditors, and this money, even on a non-registered basis, is pension credit eligible at age 65 and over. Now let's compare bank GICs to an insurance GIC, again, like the one Empire Life offers, for non-registered monies. There's advantages for estate planning, and again, a beneficiary has been named for the GIC at Empire Life. Again, the bank GIC at death, the assets form part of probate, there may be fees attached to that, it can be a lengthy process and a public process. The balance goes to a beneficiary after what could be a protracted period of time. With an insurance GIC at death, with a named beneficiary, it may bypass probate. There are no fees, no early cancellation costs. It may be far quicker payout than a bank, and of course, all of it can be private. Why segregated funds? That's the title of today's sessions. On the income side, aging Canadians want and value guaranteed lifetime income in addition to government benefits. They expect advisors to inform them of the options and how they can address their concerns and help fulfill their plans. Yes, the entire investment portfolio and the cash flow may not need to be guaranteed. It's important to allow for flexibility to adapt to changing circumstances. It's equally important to allow for growth in the overall portfolio to deal with longevity and potentially higher costs far down the road. We learned from the 2017 report, Designing Retirement Schemes That Canadians Want, that at a base level, the vast majority of Canadians want guarantees. They are willing to pay more to get them. They value risk minimization and participation in growth opportunities. They are looking for advice and guidance. The proportion of their investable asset block that provides this will vary from client to client, from age to age, circumstances, gender, and priorities. Most clients are unfamiliar with segregated funds, and many advisors have not appreciated why segregated funds should be part of their discussions and recommendations. As you've learned today, some of today's content has emphasized the advantages of segregated funds, particularly on the current volatile and decimating market conditions. So here are top 10 reasons to choose Empire Life Guaranteed Investment Funds. A short summary, and why they are the right product for you and your clients. 1. It comes in 3 levels of death benefit and maturity guarantees: 75-75, 75-100, and 100-100, respectively. 2. It provides a broad range of investment options, Canadian and global, from bond funds up to 100% equity funds, and now 8 new funds, including active and passive options. You don't have to choose. 3. You have access to Emblem Portfolio, our very popular managed program, which instantly diversifies your clients' investments. 4. It's available in fast and full investment apps. Our industry-leading segregated fund electronic application, the most comprehensive end-to-end process for new investment and life business, for good times and times like these. It was designed years ago for automation and non-face-to-face and securing new business, and now is ideally positioned to help you stay in business, to help your clients interact and move forward business, to move forward with investments in a non-face-to-face, self-isolating scenario. 5. You can hold your high net worth clients' preferred pricing starting at $500,000 per household. 6. This product provides automatic annual death benefit guarantee resets to age 80. Compensation may be done your way with front end, low load, no load, deferred sale charges, and fee for service. 8. Empire Life has been managing money for over 50 years using a conservative, value-oriented, and disciplined investment approach with an emphasis on downside protection. And our owner helped develop segregated funds. 9. Market opportunities. Empire Life's Guaranteed Investment Fund has features that are attractive to younger markets, as well as the over age 80 group in terms of both benefits and strategies like ageless investing. 10. Solutions can be structured to benefit younger markets and the over age 80 group, again combining investment planning with estate planning and wealth transfer strategies. Speak with our account executives about product and strategy details. If you haven't used our fully automated non-face-to-face new business process, speak with them about that on how to stay responsive, safe, and active in your business. What better time to speak with your clients about investing and why those investments should consider and seriously consider the many benefits of segregated funds? What better time to partner strongly with Empire Life for the reasons already stated and because of the following. 1. We are one of the most strongly reserved and capitalized insurers in Canada. And 2, we've been voted the #1 life and health insurer for 3 of the last 4 years. Investors appreciate transparency, simplicity, quality, predictability, and peace of mind. They hope that their advisors do as well.